All right. What is up, tycoons? What's up, traders? Super excited for today's video. We are going to do another TLT update. I'm going to break down TLT. There's been lots of really good buying and selling opportunities on the chart. This is our daily time frame chart. Now, the main thing I'm paying attention to is this wedge we have right here, and it's contracting very much. We're going to be seeing a big move to the upside or to the downside, I think sometime soon over the next coming months, if not sooner. We're also testing some very important trend lines here on the relative strength index. We keep bouncing off of this bullish divergence trend line, and eventually this trend line can break. So, that's going to be a big key. Another thing is going to be the MACD. We're going to be looking for our next signal, whether it's going to be an entry or exit signal. Make sure to stay tuned for that. We're also going to cover the volatility in the bond market, right? So here we actually have the bond market volatility versus the stock market volatility. And the bond market, guys, has been much more volatile than the stock market. I mean, this is absolutely crazy. I personally don't know the last time in history that the bond market was more volatile than the stock market. I'm sure it may have happened before, but we're going to cover that. And it's really picked up since March, when a lot of the banking crisis first started to happen, when the Fed printed a bunch of money. As a result of that, we've seen tons of volatility in the bond market. I'm going to go over that. As always, the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. Be sure to read through the full disclaimer, and we're going to go ahead and move on forward. Now, what we're looking at here is something really, really interesting. Okay, so what this shows is that in the past, markets sold off about roughly negative 15% following cuts in pre-recession easing cycles, right? And so that's what this red line is right here. Okay, this is going to be the pre-recession easing cycle. So this means that the Fed cuts or starts pausing, and then we get a recession afterwards. You can see it does not look pretty for the stock market, right? But it was followed by roughly 5% up moves following preemptive pivots. So if they pivot and we end up not getting a recession or we get that soft landing, you can see it has been kind of good for the stock market. Now, this is currently where we're at right now. So we're going to see how this ends up developing and playing out once we actually get that pivot, right? Is the stock market going to head into a recession and go down? Or, possibly can we escape that recession, maybe get a soft landing and start to see a rally in stocks? Now, what's interesting is that 2/3 of economists expect a US recession. So if we go back to this chart and we get a pivot and we get a recession, that could be very bad for the stock market, okay? Now, equities on average continue to rise after the last Fed rate hike, right? And we can see here, these are all the different times that we've got the end of the hiking cycle. There's been multiple times, though, where stocks have fallen very sharply. Now, over here in 74, that's what this line is right here, this blue one. We can see that there was a dramatic sell-off, but eventually things actually recovered and we went back green. All right, now 2 other time periods are going to be in 81 and then as well in 2000 when the stock market was very bearish. Other than that, equities on average continue to rise after the last Fed rate hike. All right, but it's very important to, not stay focused on one specific chart, right? So this one is a little bit more bullish here. But if we go back to this one, we can see that, when they do the last rate hike and they pivot and we head into a recession, it typically hasn't been very good for the stock market. All right. So, take everything with a grain of salt and, use all of the different data to come up with your own conclusions, right? You don't want to look at just one data set and not the big picture. You also want to see the opposite side of the data set that you're looking at, whether it's bullish or bearish. Now, why are we seeing record short positions in the stock market right now, right? And what we're seeing is this is the S&P 500 futures short positions. Okay, this is not your typical put to call ratio, which is very different than looking at the actual futures positions. Okay, typically the futures traders will get things a little more right than the put to call ratio. A lot of times the people look at the put to call ratio and think that the stock market is actually going to do the opposite, right? So if it's a super bearish put to call ratio, they think that the stock market might actually go up. And if it's a super bullish put to call ratio, they think it might go down. Again, this is very different from that. This is actually S&P 500 futures short positions. Now, why may that be? Well, if we look at other periods of money supply contraction other than 2023, we have the Great Depression in 1929, we have the Depression of 1921, we have the panic of 1983, and we have the 1870s banking crisis. Now, one thing that I will, point out about this is that the economy in the U.S. have really changed over the past 100 years, right? This data, applies to a much different economy than the one that we're in right now, in a much different environment. Okay, technology and innovation have really changed a lot of the ways that the U.S. economy works and functions as a whole. So keep that in mind. Okay, just because we're seeing something that hasn't happened, or typically that happens, and we see really bad panics and crises or depressions, that was a very long time ago. So history may repeat itself, but there is the chance that this time could be different. Now, that is a very dangerous phrase to say in the stock market and in the investment world, that this time may be different. So you don't always want to invest or bet on things based on this time may be different, right? Now, all previous situations had unemployment rate north of 10% and massive bank failures, right? If we zoom in a little bit more on that chart now, we can see where we're at now, and we can take a look, and we can see we're below the depression of 1921, below the panic of 1893, and below the 1870s banking crisis. Now, this was the Great Depression. This was the only time that the money supply growth really contracted more than where it's currently at right now. Right now, another reason that economists think of the recession is because of the rapid pace of the U.S. interest rate hikes. We've seen a record, just the pace at which they're hiking the federal funds rate. Now, that doesn't mean that it hasn't gone higher before. It definitely has, but the rate at which they're increasing it has just been really, really historic, right? And so that's another thing that has a lot of economists, thinking that we may actually see a recession. Another thing too, if we take a look at loans and leases and bank credit, all right, this is our growth trend right here. And so essentially, what you see is you see it in equilibrium, right? It usually shifts back towards equilibrium. Okay, so what I mean by that is, we see it shoot up rapidly, right? And then we see it come back down towards the growth trend, right? And then it goes down below, and what does it do? It comes back above, right? And now we're at this period where we're really high, and we could see it contract, right? And this is the total bank loans we're looking at here in blue. So, essentially what we're saying here is that, there's the banking crisis going on, and lending standards are going to tighten, and this could contract and come back down, and ultimately be one of the things that help factor into a recession possibly coming in. Now, I mentioned we're going to talk about bond market volatility. So what we have is the bond market volatility here in red, and then we have the stock market volatility here in black. Now, what I want to highlight to you guys, if we take a look, this is from the beginning of 2022, right? So if we look at the beginning of 2022 to the peak in stock market volatility, the VIX index, that went up a total of 108%. That was the highest that this has gone. It hasn't seen a bigger increase in that really since the first quarter of 2022, right? It's actually made lower highs each single time in the stock market when it comes to stock market volatility. But when we look at the bond market volatility index, right, from the very first day of January, or I'm sorry, the very first day of 2022, this thing spiked up 139%. So in the past year, the bond market has literally been more volatile than the stock market, right? And that's something that's really, really surprising to me. If you take a look, we made highs, higher highs, higher highs, higher highs. It's a clear uptrend, guys. Not only that, we're making higher lows, right? Low, higher low, higher low, higher low. Now, this could continue to drop down, but this is why we're seeing such, really, really historic volatility in the bond market. We're seeing TLT up 2% one day, the next day it's down 2%. The next day it's up 1.5%, the next day it's down 1.5%. Really, really big overnight moves in the bond market. And I'm going to dive into a little bit more of why I think that is personally. But before we do, right, let's take a look at the bond market and stock market volatility again. But this is the beginning of March right here, right? And so if we take a look, the stock market volatility rose about 43% around the time of the banking crisis. And the bond market volatility, again, was more volatile, rose about 50%. Now, we've seen a steady decline in those afterwards. But even since, really those time periods, bond market volatility is still up 7% to where it's at right now. Meanwhile, stock market volatility is down 7% to where it's at right now. So we've actually seen a decrease in stock market volatility, but we've actually seen an increase in bond market volatility since the beginning of March. That's, to me, guys, again, is just really, really interesting, right? These aren't typical, things that you're going to see, right? Typically the bond market should be much more stable and less volatile than the bond market. And in my opinion, this is largely due to these bank collapses and, having to liquidate their treasury positions, right? A lot of them are in these tough situations where they need to liquidate their treasury positions to get cash, right? They have cash in the form of treasuries, and they're having to sell massive, massive amounts of treasuries, and that massive dumping, right, in very short periods of time is going to cause really heightened volatility in the bond market, right? If you're seeing them sell hundreds of millions or billions of dollars in treasuries, that's not going to happen very smoothly, right? You're going to see big swings to the downside and, big swings to the upside as, the bond market will typically correct itself. And, it's much larger than the stock market, way more massive than the stock market. And so the bond market, is going to try to correct itself after these huge liquidations and huge forced selling pressure. So, you may see it go down 2.5% in one day, and then the next day it gaps up, right? And a lot of people are really confused. They're losing money on their trades. They're not understanding the key areas of liquidity when it comes to the supply and demand zones. That's where the liquidity is going to be drawn from, is from those major supply zones and those major demand zones. Price is going to shift towards those imbalances, those areas of imbalance, right? So if there's huge selling pressure, it's going to shift down until it reaches a demand imbalance, right? An area where there's an imbalance of demand, and that liquidity can be soaked up and bought up, essentially, because the demand there is very strong. There's an imbalance, and that imbalance just simply means that there's more buyers, there's more demand than sellers at that area. So it's going to shift down and continue to sell off until it reaches those areas of liquidity, right? And that's how I tend to trade TLT on a day trading and, a very short-term swing trading basis, is going over those major supply and demand zones, right? And trying to enter positions in those areas of liquidity, right? Entering in between those supply and demand zones, I like to call that no man's land, right? And the reason being is because you're not really sure where price is going to go, right? If you're entering in the middle of a supply and demand zone, in between those areas, the market may push back up into into an area of supply to make the next move down, or it could push lower back down into a demand zone to look for a bounce up, right? And you're not going to have that edge that you need in the market. Now, when we look at the overall scheme of TLT, again, I mentioned in the very beginning, what we're looking at here is, just a broadening, not even a broadening, but a really tightening and a contraction of the price action here, right? We're still making lower or higher lows here, but we're also making lower highs as well. So, we're really stuck in this triangle pattern right now, and it's really starting to get tight. Now, all of these blue boxes here, these are what's known as gaps, okay? Gaps tend to fill about 90% of the time historically. The big question is when they're going to fill. So I like to chart up these gaps so that way I can be prepared, potentially scalp a move as we try to fill a gap, right? I can look to play the gap. Now, we came down, we filled most of this gap down here. We had to about 102 here recently, and then we saw a huge spike up afterwards, and we started to pull back again. And, as I mentioned, it's been very tough for a lot of traders here. One thing that I want to point out is that there still is really good trading opportunities in the bond market if you know what to look for, right? And some of the things that I like to look for are multiple signals aligning together. So for instance, over here, these yellow lines, yellow arrows, they indicate double tops, right? So here we had a double top pattern. All right, ultimately ended up forming a nice M pattern. So, I was looking to potentially go short here, right? Not only are we at the top of this trend line here, but we also have a double top, and we were forming a rising wedge in this time period, right? Now, chart patterns may not be the only thing that you want to look for, right? You want to look for multiple strategies aligning together. So we have a couple things on the chart candlesticks with the wedge, or I'm sorry, the rejection of the trend line here. We have, the rising wedge here. We have the double top. Maybe you want some more confirmation. You can use the MACD to spot potential entries and exits. So an exit is going to be when the red line crosses below the yellow line here. That would be known as an exit signal. And you can see on the chart pattern, we get a very clean breakdown, retest of the trend line, and push lower, right? Right after we got that MACD sell signal up at this time period. So you combine a lot of that stuff together and it can help you out on your entries and exits, right? Again, no one strategy is going to be 100% guaranteed, but when you can start to combine multiple things together, you can at least have a little bit more confidence in your play and hopefully work on developing something that gives you an edge personally. Then right after that, what do? We formed a double bottom here, okay? Then we actually had bullish divergence, which if you take a look at these circles, we have what's known as a low and then a lower low here, right? So price action was going lower on the stock of TLT, but we actually saw a low and a slightly higher low right here. So we actually did something known as bullish divergence. And that's what occurs when you see a divergence between the price action going lower and you actually see the relative strength index slightly increasing here. That would be a term known as bullish divergence. We also got a bullish candlestick pattern known as a abandoned baby right here, really indicated by these three candles. Okay, if we take a look here, it's going to be these three in particular that you want to pay attention to. This is the abandoned baby candlestick pattern. All right. And we saw a very, very strong push at that point. Now, again, maybe candlestick patterns aren't going to be the only thing you want to pay attention to, even though we have multiple. We're also seeing bullish divergence here, right? So that's another thing to possibly give you an edge. And we see that crossover. We see the red line cross above the yellow line. That's a potential buy signal, right? And we saw a very strong push to the upside afterwards, okay? Now, again, after that, we ended up forming another double bottom, seeing a strong push up. And really we saw the MACD curl back down right over here at this time period, and we saw another strong push down. That's when we formed that double bottom and we ended up seeing a strong push up. So to make things relevant to where we're at right now, okay, look at how many times we've bounced off of this bullish divergence trend line. Many times. And so really the reason that that's significant, okay, is because the more times you test a trend line, the weaker it gets, right? And if we see a break in this bullish divergence trend line, that could mean that we're due for a move down on TLT. We also have the MACD really just tight and ranging right here, right? If we look, we haven't seen a crossover to the upside. We haven't seen a rejection and a push down. It's really just been ranging here. And when the MACD does this, it typically means that a big move is coming sometime soon. Now, when that will be, we don't know, right? We do know that we're testing this bullish divergence trend line. We could bounce off of this thing again, guys. It's been a really strong level, right? We've bounced off of it many times. After we got this bullish push, those same buyers that were buying off of the bullish divergence, they're coming in and they're stepping in and buying each time that we test the trend line here. So this thing may cross over to the upside, potentially give us another buy signal, and we may see a strong push up, or this thing could break, guys, and we could see the MACD curl down and give us an exit signal. We're going to look to see, do we potentially bounce off of this trend line? 102.88 is a big support level, really major level. All right, as you can see here, when we had this massive sell-off in TLT this day, that's actually where we found support, was there at 102.88. We haven't really been able to break below that level since we got back above it, right? Since we gapped up above 102.88, we've really stayed above and been consolidating within this little range right here, you could call it. Okay, so that's pretty much it for today's video. Wanted to give you guys an update on TLT. Also wanted to give you guys an update on some of the different things that I'm looking at in the economy from a macro perspective, some things that we need to be cautious of, maybe some things, that could potentially be bullish. It all just depends on, what the data is when it actually comes out. All right, we don't know what exactly is going to happen in the future. We can't really predict these things, but what we can do is try to prepare ourselves. All right, and we want to stay prepared for either scenario and not be too biased to one side. So that way, we end up missing some of the really important data that could have helped us and prevented us from, making the wrong move. All right, so smash that like button, subscribe to the channel. If you guys want to support the channel and help the channel out, check out the pinned comment below and feel free to sign up for one of the links down there. Okay.